Hey guys, good evening. Good evening, all of you. Okay, guys. Good evening, Ashwat. Okay. So, a lot of students are waiting for this class, guys. So, I received so many messages regarding this valuation of assets and liabilities. So, here is a class for you. So, when it comes to chapter 7, valuation of assets and liabilities. So, it is the next biggest thing and the important chapter we have after mergers and acquisitions. When it come to this valuation of assets and liabilities, in previous class I explained regarding mergers and acquisition. On that mergers and acquisition, you understand there is a few concepts, multiple problems. But when it come to this valuation of assets and liabilities, we have a multiple concepts as well as multiple problems, multiple multiple concepts and multiple problems. Okay, let us check what are the concepts. Let us check first what are the concepts we have. Concept number one, valuation of plant and machinery. Concept number two, valuation of inventory. And concept number three, valuation of investments. In this valuation of investments, again they are classified into valuation of shares, valuation of debenture and bonds, valuation of rights, valuation of warrants. Hope you guys clear. Next, valuation of intangible assets. Here is not a single concept. It's again classified into valuation of copyrights, valuation of brands, valuation of goodwill, valuation of trademarks, valuation of human resources. Next, valuation of economic value added and valuation of market value added, valuation of real estate, valuation of liabilities. These are the concepts we have, guys. These are the concepts we have. So after knowing the how many concepts we have, let us check which concepts are important in exam point of view. So when it comes to exams point of view, the first important concept is valuation of economic value added. Yes, Gopika, we will discuss workbook problems of this chapter today. So important concept, first important concept is a valuation of economic value added. In entire workbook, they focusing only on economic value added concept. So out of 11 or 12 problems is there, majority of problems are economic value added concept problems only. Okay. Next, valuation of market value added. Generally in our main board book, they provided only theory content regarding market value added concept. In new workbook, so issued by ICMA, they're focusing one of the problem on market valuation, market value added. Also there is a one problem is there regarding to market value added. Okay, so first important concept, economic value added. Next important concept, valuation of branch, valuation of branch. After that, valuation of human resources, valuation of human resources. And next, valuation of goodwill, valuation of goodwill. After that, valuation of shares important and valuation of warrants important. So it is a easy concepts. We have valuation of warrants. In attempt by attempt, they ask for MCQ as well as main question, MCQ as well as main question. Important concept. After that, valuation of plant and machinery and valuation of inventory. Only few problems, one or two problems are is there regarding to plant and machinery concept as well as inventory concept. Hope you guys clear. Now, without late, I start with the economic value added concept. Economic value added concept. See, so this is the economic value added concept. So in subject point of view, nothing is new is there. Nothing is new is there in economic value added concept. So the word itself saying that economic value added. So economic value added means if I procure 100 crore rupees from the market for a business, if I invest in my business, if I invest in my business, how much how much profit I earn, how much profit I earn. So 100 crores, it is a loan taken from the outside. I invested same 100 crores in business. With help of that procurement and with the help of that with the help of that procurement, with the help of that investment, how much profit I enjoyed, how much profit I enjoyed. So simple. So for procurement of 100 crores, you have to pay cost, you have to pay cost. So for investment of 100 crores, you received a revenue. Now what is the profit? Revenue minus cost, revenue minus cost. This is called economic value added. This is called what, guys? Economic value added. That's simple thing. So return on investment minus cost. So instead of cost, I am using ko or cost of capital or weighted average cost of capital. So this is called economic value added. Economic value added. For example, for a procurement of 100 crores, I have to pay 10% cost per year. So if I invest that 100 crores in my business, I received 15% of profit, 15% of profit. So out of this 15% of profit, I can't take entire 15%. I have to pay say I have to pay commitments. The commitment is 10%. So return on investment is 15%, weighted average cost of capital or overall cost of capital is 10%. So how much I can enjoy? Only 5%. This 5% is known as economic value added. Hope you guys you understand the concept of economic value added. Now after the concept, when it come to the calculation part, so the calculation part, I classified into three types: basic version calculation, medium version calculation, and standard version calculation. So nothing is new, guys. All three, basic version or medium version or standard version, all three will give same answer. All three will give same answer. But for the purpose of presentation, I classified in these three manners. The first, basic version. Generally, actual profit, that is nothing but return on investment in rupees, minus expected profit, that is nothing but cost of capital. So minimum expectation is nothing but cost of capital. So it also be in rupees. So economic value added, that is nothing but gap. So what is our example? 100 crores is a capital we procured. Out of this 100 crores, 10% is expected profit from that 100 crores. So if I invest that 10 crores, 100 crores, I receive return on investment 15%. So 15% is nothing but 15 crore rupees, and 10% is nothing but 10 crore rupees. Economic value added equal to 5 crore rupees. Guys, clear? Next, when it come to medium point of view, just it's a presentation changes, guys. Answers are not changed. All models give a same answer. Now economic value added, return on investment minus cost of capital into capital employed. You can observe return on investment 15% minus cost of capital 10% into capital employed 100 crore rupees. Now 5% into 100 crores, 5 crores. Same answer. Next, when it comes to standard point of view, you can observe these are words are changes. No pat minus weighted average cost of capital into uh, operating capital employed. Now Let us decode. So this is the formula in majority cases we are using. Economic value added equals to no PAT minus weighted average cost of capital into operating capital employed. Operating capital employed. Now let us check. The word no PAT means, the word no PAT means net operating profit after tax. This kind of words we already learned. No PAT is nothing but EBIT 1 minus tax. If you wrongly taken EBT, if you wrongly taken EBT, that is a wrong answer. EBT is a taxable profit. EBIT into 1 minus tax is a no PAT, net operating profit after tax. Don't confuse. So generally what we do, EBIT less interest, you will get EBT less tax. This is the procedure we are following, right? Here I am not doing this procedure. I am directly deducting tax from operating profit or business profit. I'm not reducing interest. Why? Because you already know calculation of FCFF and FCFE. At calculation of FCFF and FCFE, we are deducting interest after FCFF receives. After FCFF receives. That's why here I am not reducing interest first. I'm reducing after getting FCFF only. So that's why directly you have to deduct tax at EBIT. So don't confuse, don't take EBIT for no PAT. No PAT means EBIT into 1 minus tax. Guys, clear? Next, weighted average cost of capital. You know how to calculate KO. Specific cost of capital of equity into weight of equity plus KD into weight of debt. So in maximum of the problems, they focus only equity share capital and debt capital. That's why I used only two things. If they provide multiple things, you have to consider multiple things like plus KR into weight of R plus KP into weight of P plus KT into weight of T. So but maximum of the cases they are not give these three capitals. That's why we have consider only equity and debt. So another important point you have to understand at the time of KO calculation, unless they specify, if they gives a KD equals to 10%, the 10% is a pre-tax one, you have to convert that into post-tax. At calculation time, you have to use only post-tax values. So how I get a post-tax means KD into 1 minus tax. KD into 1 minus tax. So after no PAT calculation I know, and WAC, weighted average cost of capital, I know. Next point you have to understand. You have to understand operating capital employed. So operating capital employed means sum of all capitals is known as the operating capital employed. Sum of all capitals. Sum of all capitals is known as operating capital employed. But here also one note point is there. If any non-trade investments are involved, if any non-trade or non-trade or non-business investments are included, you have to exclude. If it is included, you have to exclude. That's why I used a name called operating capital employed. What are the capitals you are utilizing in business? That only you have to consider. If you are not consider that operating capitals, if they give a non-traded investment, that is not relating to business. That's why you have to consider only capitals you are invested in business. This non-trade investment is not relating to your business. Guys, clear? Yeah. So as well as if there is any non-trade investments, their returns also impact your no PAT. So at the time of calculation no PAT, you have to consider any return if relating to non-trade investment, you have to readjust. You have to readjust. Guys, clear? Now, so that's it. If you know this all, you can easily answer economic value added problems. So I already told in that the time of methods and approaches, economic value added concept involved in two chapters. One is methods and approaches as well as assets and liabilities. For student understanding purpose, I sent it all approaches and methods problem into that assets and liabilities chapter. But when it come to board book, they are considering in two chapters. Don't worry. So we are sort out that. So let us check illustration number 16. So where it is, we don't know. I know the concept, we can easily answer. So Piyush Limited provides you with the following financial information as at 31st March 2024. Now share capital 981.46 lakhs, reserves and surpluses 1313.62 lakhs, long term debt 144.44 lakhs, and trade payables 20.38 lakhs. Profit before interest and tax 222.84. I consider it is a EBIT. Okay. Interest paid 13.48 lakhs. Okay. Tax rate 30%. Cost of equity 12.42%. Cost of debt 6.53%. Required to calculate. Required to calculate economic value added of QZY Limited. QZY Limited. Now see. First, you have to calculate NOPAT. NOPAT. So PBT is given less interest. You will get PBT less tax. You will get PAT. Add back interest tax. You will get NOPAT. Okay. So they are calculating this way. They deducted here. They add again here. So but we do simply 220 or 2202.84 into, so as of our knowledge, NOPAT is nothing but EBIT into 1 minus tax. Now what is the EBIT, guys? 2202.84 lakh into 1 minus 0.3. Now 2202.84 into 0.7, that is nothing but 1514.988. So if you do as per they provided, you will get the same answer. As per our basic version also, we are having a same answer. Guys, clear? Okay. After getting a NOPAT, what's the first, write down the formula properly. Economic value added equals to NOPAT minus WACC into operating capital employed, right? Now I have NOPAT. How much? 1541.988. Now I don't have a WACC. I need to do working note for weighted average cost of capital calculation. Now, so I already said KO equals to weight of equity plus cost of equity plus weight of debt into cost of debt. Cost of debt. So you can observe the capitals. Share capital is there, reserves and surplus is there, long term debt is there. So share capital is a part of the equity. Share capital also part of the equity. Now, before that, we have to calculate operating capital employed. So share capital plus reserves and surpluses plus debt. Now share capital equals to 981.46 lakh. 981.46 lakh. 1313.2 lakh. 144.44 lakhs. So operating capital employed equals to 2439.52 lakhs. Okay. So in formula, operating capital employed also completed, no part is completed, WACC only. Now, how you get a weight of equity? Simple. Equity share capital divided by total capital employed. So what is the equity? So 981.46 plus 1313.6, 2295.08 equity divided by total capital employed 2439.52. Not plus, guys, it is into KE given in the question, 12.42%, 0.1242 plus weight of debt, amount of debt capital 144.44, 144.44 divided by 2439.52 into KD. So you can observe the word cost of debt. So you can observe the interest paid 13.38, 13.48 lakh divided by 144.44 into 100. So general interest rate is 9.33%, but they provided here 6.53%. So how we get that converted? 9.33 into 6.5% means it is a post-tax KD. Post-tax KD. Don't deduct tax from this one. They already deducted. So you have to cross-check that. Now 0.0653. So if you solve this calculation, you will get KO. So I'm directly taking the answer 12.07%. Now all working notes are completed. So NOPAT is 1514.9888 lakhs and WACC 0.1207 into operating capital employed 2439. 2439.52. So after solving this, 0.1207 into 2439.52. So the 1541.988 minus 294.45. 1541.988. So the answer 1247.53. So this is the economic value added enjoyed by a company. Guys, clear? Any doubt regarding this economic value added calculation? Speed up. You have any doubts? Ask me now. Economic value added. So it's one of the important concepts we have in this chapter. Please respond. Gopika and Aswati. Is it clear? Economic value added concept. So multiple models we have in this concept. but formula is same for all models. Now see illustration number 6. Compute the economic value added for 3 years from the information given. So we have year 1, year 2, year 3 information. You have to figure out economic value added for year 1, year 2, year 3. Average capital employed is given. Operating profit before interest before interest. Operating profit before interest, that is nothing but EBIT. Corporate income tax rate. Oh, sorry, rupees, guys. It's not rate. It's rupees. Average debt or average debt divided by total debt. There is nothing but weights. Weight of debt. So if weight of debt 50% means the pending 50% is weight of equity. So if weight of debt is 25%, weight of equity equals to 75%. If weight of debt equals to 20%, weight of equity equals to 80%. Hope you guys clear? Done. Beta variant. Beta 1, beta 2, beta 3. 3 betas is given. Risk-free rate RF. Equity risk premium RM minus RF. I said this concept in chapter 5, introduction, fundamentals of business valuation. So it is not a RM, guys, it is RM minus RF. Cost of debt post tax. So if the word specifies post tax, you don't convert into KD pre-tax to post tax. That's why you can directly take it as a KD for calculation. Don't deduct any tax. Okay. Now first you have what is the formula? Economic value added equals to NOPAT minus back into capital employed. So instead of capital employed, in this question they used average capital employed. Yes. So average capital employed. Okay. Now in this average cap, instead of capital employed, we are using average capital employed. This one. Next, no, we need to do working note for NOPAT calculation and WACC calculation. WACC also not given. So before WACC, so WACC equals to KO, cost of equity into weight of equity plus cost of debt into weight of debt. Guys, clear? Deepak. Good evening, sir. I found an easy way to remember B score in chapter 4 posted in your respective so they can get benefit. You can please ask them to refer that. Okay, Deepak. I observed evening only. So it's amazing, Deepak. You put a lot of efforts for that creation. Thank you from my side as well as student side. Okay, now in front of us, first task is KE calculation. After that, KO calculation. See, proportion of debt they taken, cost of debt directly taken. If KD into weight of debt, you will get a product of debt. So this is K weight of debt. This is cost of debt. Multiply, you will get a product of debt. Next, proportion of equity. Before proportion of equity, you have to calculate a cost of equity. So beta 1.4, 1.2, 1.7, 3 betas is given and 3 RM minus RFC is given. You know CAPM model. By using that CAPM model, you have to figure out that KE for year 1, KE for year 2, KE for year 3. Now, if you do this, you will get a KE. Now, this is called weight of equity. This is called cost of equity. If you multiply, you will get a product of equity. So sum of product of debt and product of equity is known as a KO. This is a KO. Guys, clear? Next, you have to figure out a NOPAT. You have to figure out NOPAT. So how we get a NOPAT? So EBIT 1 minus tax. EBIT 1 minus tax. They're directly given tax rupees. So next 1000 minus 120, 1500 minus 150, 1800 minus 200. So you will get NOPAT directly. So 880, 1350, 1600. WACC I calculated. Now WACC into average capital employed. So you will get answer no PAT minus KO into average capital employed. So the answer 256 lakh, 627.5 lakh, 683.2 lakhs. So this is the way to calculate economic value added. So first problem we discussed is this is only single year information economic value added calculation. This is a 3 years economic value added calculation. So you can observe this also be economic value added related concept only. Breakdown on company limited is given below. So sales total income less manufacturing cost on administration cost, selling and distribution cost, depreciation, EBIT 3400 less interest, EBT less tax, PAT, EPS, PE ratio. So PAT PE ratio. So I already told lot of times if you have a PE ratio means it is a clue for either maximum of the cases MPS calculation or it is a clue for EPS calculation. Now MPS equals to PE ratio into EPS. Now what is the PE ratio? 3 times into EPS 45.5. 136.5 per share. This is the MPS of the company. But we are not using MPS in economic value added calculation. Okay. Anyway, let us check. Balance sheet is given, equity is there, reserves and surplus is there, term loan is there. This is sum is known as operating capital employed. There is a no non-trade investments. If there is a non-trade investments, you have to deduct from this operating capital employed. If there is a no non-trade investments, that's why I'm summing all capital is nothing but operating capital employed. So operating capital employed equal to 500 plus 350 plus 50. So 1500 is operating capital employed. Okay. Next, the cost of equity 14%, cost of debt 8% respectively. The company pays 30% corporate tax less. There is a no specification. That's why you have to convert this 8% into post tax. So 8% into 1 minus tax, you will get a post tax KD. Now from the information given, you are required to calculate economic value added, also calculate market value added. So nothing is new in economic value added calculation. I already have a capital employed. Next, no PAT equals to EBIT 1 minus tax. I think EBIT given in the question 3400. 3400 tax rate 30% means 0.7. Now the no PAT equals to 3400 into 0.7, 2380. No PAT also completed. Now the only issue is back not directly given, you have to figure out. Now KO equals to equity share capital. This 2 is known as equity, right? You have to consider both. 500 plus 350, 850 divided by 1500, you will get a weight of equity into cost of equity given in the question 0.14 plus 650 divided by 1500 into 0.08 into 0.7. 1 minus tax you have to consider. Now if you solve this, you will get an answer. So this is 5.6%. So weighted average cost of capital equal to 10.36%. Don't worry about this. They consider individually. So if sum also, you will get the same answer. If you do in individual also, same answer. You can observe in our answer 850 divided by 1500. That is nothing but 0.566 bar. I consider 0.567 into 0.14. This is the product of equity. Let us check in the KD point of view. 50 divided by 1500, 0.433 into not 8%, 8 into 70%. 5.6 percent, 0.056. Now 0.433 weight into 0.056. So 0.0242, 0.567 into 0.4, 0.0793 plus product of debt 0.242. So the answer is 10.35%. So 10.3588%, they're approximately taken 10.36%. You can observe 10.36%. What I did means I consider reserves and surpluses and equity share capital in one frame, but in this presentation they consider individually. So you can do individually or in summation, you will get the same answer. Why? Because KE equals to KR. So I explained at the time of cost of capital chapter, if KE not equals to KR, at that time you have to do separation. Unless they, you have to go with the summation or total point of view, equity point of view, or individual point of view, give a same answer. So economic value added concept completed. Next, the concept is market value added. So when it comes to market value added, this is a formula: market capitalization minus book value of a net worth. Write down the formula, guys. So market value added equals to market capitalization minus book value of a net worth. So how we get a market capitalization? They not give directly, they are all provided book values. Now we have to figure out market value. So market price into number of shares, you will get a market capitalization. I already roughly calculated MPS initial stage only, 136.5 rupees. 136.5 rupees into number of shares. So number of shares is there, 500 capital divided by face value 10 rupees, 50 lakh shares, 50 lakh shares. Now 136.5 rupees into 50 lakh shares, the market capitalization 682, 6825 lakh. So 6825 lakh. Now book value of a net worth. So I already said net worth means equity. Net worth means equity. That's why you have to consider only this two, not total. Capital employed is different, net worth is different. So the net worth is 500 plus 350, 850 is the net worth. So 6825 minus 850, the answer is 5975 lakhs. So this is the only one problem we have for calculation of market value. Hope you guys clear, all of you. So please respond, guys. Speed up. It also be a basic problem like economic value added. So if you have if you understand this concept, I will go with the next concept. Speed up. Please give me your valuable reply. Are you understand or not? After this economic value added concept, next another important concept is called brand valuation. So when it come to brand valuation, so here also two types of problems is there. Basic model, standard model. So when it comes to basic model, brand earnings equals to brand income minus unbrand income. So this is the formula for brand earning calculation. So when it comes to valuation, brand earning is not a value, guys. So when it comes to valuation, brand earnings divided by required rate of return, you have to do capitalization. If you do the capitalization, the profits are converted into value. So this is called valuation. So this is called calculation of brand earnings. The basic version. When it comes to standard model, so they will give a profit before interest and tax. You have to convert that profit before interest tax into brand earnings with the help of lot of adjustments. After getting the brand earnings, you have to capitalize, you will get a valuation. Now the point of here, you have to add non-operating or non-cash expenses, as well as you have to reduce non-operating or non-cash incomes. After that, you have to do adjust of inflation. So there is a very important adjustment called inflation. So if you are adjusting the inflation, after that you have got a inflation adjusted earnings. After that inflation adjustment, you have to do weighted average. You will get weighted average. After do the weighted average, you will get a multiple earnings into single earning. After multiple earnings into single earning because of weighted average, next you have to pay taxes if any is there. Taxes if any is there, as well as any other adjustments of incomes and expenses. You have to do adjustments here. You will get a brand earnings. You will get brand earnings. Now you can observe here. So brand value. So branded income, that is nothing but number. So you know the number of units sold into selling price per unit. Unbranded incomes and research and development related to brand. After deducting all this income, all these values from the branded income, you will get a brand earnings. You will get a brand earnings. Now divided with R, you will get a brand value. Divided with R, you will get a brand value. Next, so next standard point of view, note points you have to understand. Branded income equals to, they will give PBDT. On that PBDT, you have to adjust non-operating expenses and non-operating incomes. Next, another working note is important, inflation. So inflation is directly given, take directly. If percentages is given, you have to do working note. You have to do working note. Now see what is a working note means. For example, 2015, 2016, 2017, 2018, 4 timelines is there. So we are doing a valuation at a recent year. Our recent year is 2018. For example, in 2015, inflation rate is 9%. In 2016, inflation rate is 10%. In 2017, inflation rate is 15%. In 2018, inflation rate is 16%. Guys, clear? This kind of percentages they will give. If they give direct values, directly multiply the what are the given values. If they're not directly given, you have to calculate the value of inflation. Now, so 2015 we are doing a valuation here, right? Okay. So if you have a doing a valuation you are considering 2015 information, but you are doing a valuation in 2018. That's why I will give a small clue. Past is irrelevant. Past is irrelevant. Future is relevant. It means this 9% already included in 2015. It is a past. 9% already included in 2015. It is a past. So 10%, 15%, 16% is not included. If it is not included, you have to consider. So how it possible? 0.1 into 0.15 into 0.16. So the inflation value 0.1 into 0.15 into 0.16. Sorry. 1.1 into 1.15 not into plus into only 1.1 into 1.15 into 1.16. Now the inflation value 1.1 into 1.15 into 1.16. So 1.4674. If you multiply with this 1.4674, so your 2015 brand earnings are converting to 2018 brand earnings. Next, when it comes to 2016 inflation calculation, this is a past irrelevant. This is a past irrelevant. 2016 means this 10% is already included. So the only future is 15%, 16. 1.15 into 1.16. When it comes to 2017, this 9%, 10% are past. This 15% is this year included, adjusted. The only feature is 16%. It means 0.16. When it comes to 2018, so this 9% is past, 10% is past, 15% is past. This 16% already this year included. So the inflation rate is 1. So this is a way to calculate inflation values. So 1.15 into 1.16. So 1.334. So you have to multiply with this inflation and adjusted brand earnings. You will get inflation adjusted earnings. Hope you guys clear how to adjust the inflation rate. This is a one important adjustments we have. If you have any doubt regarding this inflation adjustments, please ask me. Jyoti Kanta Salasar, mock test papers and workbook. So this is a workbook explanation only more. So mock test papers, we will conduct one session for that only mock test papers. Guys, please respond about the inflation adjustment. Guys, are you listening or not? Please respond. How I know what happening? Yeah, you can observe illustration number 25. PS Limited furnishes the following information relating to previous 3 years and request you to compute the value of the brand of the company. So 2015, 2016, 2017. Profit before interest and tax. Loss on sale of asset. Loss of sale of asset is a non-operating activity. That's why you have to add non-operating income. Non-operating, they're saying non-operating. You have to reduce. This already included. Inflation was 9% for 2016, 15% for 2017. If the capitalization factor considering internal and external value driven to the brand is 14 times. So it is not a 14%, it is a 14 times. Determine the brand value assuming all inclusive future tax rate of 35%. So first you have to consider profit before interest and tax. You have to adjust non-cash and non-operating incomes and expenses. Add expenses less incomes. So you will get a brand earnings. After getting the brand earnings, you have to adjust inflation. So when you are calculating inflation, 2015, no inflation rate. 2016, 9%. 2017, 15%. In at 2015, this 9% and 15% is a feature. I already said you have to consider feature. 1.09 into 1.15. So 1.09 into 1.1. So 1.25 is the inflation rate for 2015. At 2016, this is the past. This is the past. 15% is only future. That's why 1.15 into 1. So why? Because there is a no feature now. That's why you have to consider only one feature. When it come to 2017, there is a no feature, all are past. I'm not considering past. That's why the value is 1. So 1.15. After multiplying this, you will get a inflation adjusted earnings. Now you have to consider weights, year 1, year 2, year 3. So multiply with weights, you will get a product divided with 1 plus 2 plus 3, 6. You will get weighted average brand earnings 123.65. In this you have to reduce the tax. You have to reduce tax 43.28. You will get weighted average brand earnings after tax. Now so 80 divided, if they provides rate 80 divided by 37 divided by r. If they not give rate, so 80 divided by 37 into times. If they give times, multiply. If they give rate, divide. So 14 times, that's why you have to multiply. So if you multiply with 14 times, your brand value is 1125.18 lakhs. So this is a brand value valuation, one of the important model we have repeatedly asking in new old model, as well as there is a chance of asking for this. Why? Because they asked in December 23 MTP for new syllabus. Guys, clear? Next another model in this brand valuation, another important model. So you can observe this. So in a brand earnings, we used this capitalization model. Now in this model, we are using discounted cash flow method for brand valuation. So in a brand valuation, we are using all methods based on the information availability. In our problem, we are using earning capitalization or earning times calculation for valuation. Now it's time to discounted cash flow method for the brand valuation. Let us check here. So Naturals Limited has hired a marketing consultancy firm for doing a market research and provided data relating to tire industry for the next 10 years. The following were the observations, the projections made by the consultancy firm. So without understanding of this question, you can't do, sir. With proper understanding only we can do. Okay, every point is an important point. You have to focus more on that points. The tire industry in the target area, whole of India, is expected to grow 5% per annum for next 3 years, and thereafter 7% per annum over the subsequent 7 years. So first they are not saying they are not talking about our company Naturals Limited. They are talking about the total market in the India. So the total market in India, every year they grow with 5% for 3 years. After 5 years, after 3 years, 7 years pending is there now. Why? Because discussion is related to 10 years time period. So first 3 years they are increasing 5% in industry point of view, not in our company point of view. After third year, it means fourth year onwards, it will be grown by 7% total industry. Okay. Now the market size terms of basic sales of tires was estimated at 8,000 lakhs. This is the industry sales per annum 8,000. I want If they provide growth rate, I need to consider grown value for first year. In first year, I am not taking 8,000. 8,000 into 1.05. 5% growth, I will consider that is the value. So next, the last year, the dominated by the medium and large players. This includes roughly 9% fake brands and local manufacturing types. Market share of this segment is expected to be increased 0.5%. In that industry, there is a fake and a local brands. It holding 9% of the market share. There every year increased 0.5%. Okay. Cheap Chinese import accounts. Chinese brand also, Chinese types also there. They're occupied 40% of the tire manufacturing in the India. In every year, they are also increased their market share 0.25%. Next, the other large players account roughly 35%. Remaining Indian big players occupied 35% of the market share. They are reducing every year their ownership. Okay. Now, due to expansion of Naturals Limited product portfolio, now the company is in a process of business re-engineering, which will start yielding result 2 years time and increases its profitability by 3% from existing 12%. When it comes to Unlimited, up to now we discussed only about industry. Now we are coming to our company. Our company profits are first 2 years 12%. After how many years? Yeah, first 2 years 12%. After 12 after 2 years, our profits are increased by 3%, means after third year onwards 15%. If the appropriate discount rate is 15%, what is the brand value of a Natural Limited under market oriented approach? In this problem, you have to plan first. First, you have to calculate how much market share I have. So how much market share I have? Market share, if 100 out of 100, so fake brands are 9% occupied, and Chinese products are 40% occupied, and other players in India 35% occupied. So your market share is 16% out of 8,000. 16% is your sales. 1280 lakhs is your sales. Out of 1280 lakhs, 12% is your profit. So profit into present value factor, you will get a present value. Sum of present value is known as a valuation. Okay, but here is another point is important. Every year you have to figure out your market value is increasing or decreasing. So why? Because you can observe. So fake brands are 0.5% increasing, and Chinese also 0.25% increasing, but other players are 0.5% decreasing. 0.5% are decreasing. It means every year 0.25% others are increasing. The common sense, if others are increases, automatically you are losing your market share in every year by 0.25%. Hope you guys clear. Now let us check the solution. You can observe. Note 1. Estimation of market share of Unlimited. So 100% of market, 9% fake brands, 40% Chinese brands, 35% other brands. So your market share is 16%. So note 2. Change in shares of Unlimited. So 0.5% increases fake brands, 0.25% increases Chinese brands, 0.5% decreases other brands. Net impact is 0.25%. Others are increasing. If others are increases, means our Unlimited every year 0.25% ownership are losing. Others increases means we are losing in the market. Now you can observe. So market share, years 10 years. When it come to market share, 8,000 is the current year. First 3 years 5% growth, 1.05. So 8,400, again 5% growth, again 5% growth. After that 7% per annum. So 7% growth, 7% growth, 7% growth, 7% growth, 7% growth. That's why the colors of solution is different. So black indicates 5%, this red indicates 7%. Out of this industry sales, I am calculating my share. So first year, it means end of the first year 0.25% decreases. So generally I have a 16%. 1 year completed na, per annum 0.25%, others are increases, means we are decreasing. So again next year 0.25%, next year 0.25%, next year 0.25, 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 next year 0.25. If every year 0.25 decreases, these are the share I have. Now my percentage of share into sales, I get a market value of unlimited. Out of market value, I have to consider 12% as a profit. For first 2 years 12%, next 8 years 15%. So I got profitability of unlimited. So profitability into present value factor, you will get a present value. Sum of all present value is known as a brand value. Guys, clear? Guys, clear or not? This problem, very, very important problem, guys. So economic value added and market value added completed, brand value also completed. After that, after that, next we have to focus on valuation of human resources. So when it comes to valuation of HR, in this concept also we have a basic level of problems as well as standard level of problem. So this standard level of problem we are using Lave and squeeze model, and this basic calculation we are finding maximum salary payable and maximum bid. So this is the two models we have in valuation of HR. This is very, very important, value and squeeze model. So let us check. Yeah. See illustration number 29. So this is relating to valuation of HR basic model. A company has a capital base of 3 crore and has an earned profit 33 lakhs. Return on investment of the particular industry to which the company belonging to 12.5%. If the services of particular executive are acquired by the company, it is expected that the profits will increase as by 7.5 lakh over and above the target profit. Determine the amount of maximum bid price for that particular executive and the maximum salary that could be offered to him. First, so maximum salary payable equals to is also be known as incremental profit due to introduction of the employee. So due to introduction of the employee, what happened means they will estimate profits because of that employee, that is called target profit, minus actual is there, actual profit due to that employee. So the difference is known as incremental profit. Now the target profit is given here 12.5%, 12.5% on capital. So 3 crores into 12.5%. So the capital base is given 3 crores. The target profit is 37 lakh 50,000. 37 lakh 50,000. This also they directly given in the question. So target, and also they specified in the question. So they're under also expecting 7.5 lakhs because of he was a skilled. Because of he was a skilled. So just I estimated 12.5%, but there is a chance they will give extra of 7.5 lakh. This also be a target profit. So 37.5 lakh divided by 7 plus 7.5 lakhs. So total 37.5 plus 7.5 lakhs. 45 lakh is the estimation for that person. But actually they contributed 33 lakhs. Actually they contributed 33 lakhs. Out of 45, they contributed 35. They contributed 33. So due to that, uh, I'm providing a maximum salary to that employee is 12 lakhs. Clear, guys? Next, maximum bid. They're asking next question. Maximum bid equals to maximum salary payable divided by R. So R given in the question 12.5%, right? Now, what is the maximum payable salary? 12 lakh divided by 0.125. 12 lakh divided by 0.125. So 96 lakhs is the 96 lakh is the maximum bid price. Maximum bid price. Guys, clear? So next after that, there is a concept name called leave and squeeze model. After that, there is a concept name called leave and squeeze model. When it comes to the leave and squeeze model, so they will give unskilled information and semi-skilled information and skilled information. So in this unskilled and semi-skilled and skilled point of view, you have to figure out. So first 100 employees, they joined at the age of 30 to 39. Next 50 employees, they joined at the age of 40 to 49. Next 30 employees, they joined at the age of 50 to 54. So you have to understand one thing. If this 30 to 39 age people joined 100 members here, they have a chance of they can work under 30 to 39 10 years. Next 40 to 49 another 10 years. Next 50 to 54 another 5 years. These are the possibilities they have. So the possibilities they have. Clear, guys? Next, if this 50% joined at the age of 40, they have a chance of 40 to 49 for 10 years. Next 50 to 54 next 5 years. If this 30 members joined at the age of 50, they have only possibility of 50 to 54, that is nothing but 5 years. Now, so here 10 years is there, here 10 years is there, here 5 years is there. So when at the time of calculating present value factor, so because of same cash inflows, we are using present value of annuity factor 10 years. Present value of annuity factor 10 years. When it come to here don't, we are not using present value of annuity factor 10 years. Why? Because these 10 years are not 1 to 10, it is from 11 to 20. 11 to 20. That's why present value of annuity factor 20 years minus present value of annuity factor 10 years, you will get an answer present value of annuity factor 10 to 20, 11 to 20 years. This is the only trick you have to apply. Same logic here also. Here we are not using present value of annuity factor of 5 years. Why? Because this is not 1, 2, 3, 4, 5. It is a called 21 to 25. 21 to 25. So present value of annuity factor 25 years minus present value of annuity factor 20 years. You will get an answer 5 years annuity factor. If you multiply that, you will get one employee value, and into multiply with the number of employees, you will get a total value. So you can observe my notes, there is a proper explanation is there. Yeah, see, so 180 employees, 110 employees, So for 180 employees, there is a 100, 50, 30. For this 10, 100 employees, they can work for 3. For this 50, they can work for only 10. This 30, they can work for only 5 years. So if you know this blueprint, you can easily answer. So, okay, let's come to next pending problems in this workbook, guys. So this is relating to copyrights. Here we are using discounted cash flow method. So discounted cash flow method. So what happening in this discounted cash flow method means they give sales and revenue, cost of goods sold, etc. Based on that, you have to figure out cash flows, multiply with the present value factor, you'll get an answer. The scenario of the case is one of the authors sold their books to public for they have a 10 years lifespan. After 10 years, they don't have they are not selling. It means only 10 years related information. Price of the book is 3000, number of pieces are 6500, the cost of production is 70%. The book becoming a popular and publisher estimate that sales of the book may be increased by 5% every year of the next 5 years. So first 5 years they are grown at 5%. This including newer edition of the same book. However, after 5 years, given the introduction of the other books on the same subject, dilution of exclusivity, violation of copyrights and pilgrimage, there may not be any increase in sales, but the sales may be stable at the same level at 5 years. So first 5 years, every year 5% growth. After 5 years, there is a no growth because of a new edition of the books. Okay, see, book price 3000, units sold 6500. So you received 1 lakh 90,000, 1 lakh 1 crore 95 lakhs for current year. For first year 5% increment, for second year 5% increment, for third year 5% increment, for fourth year 5% increment, for fifth year 5% increment. Behind the fifth year called terminal value. Behind the not 10 years, guys, they not specified the 10 years. Sorry, I'm taking my words back. There is no specification of the 10 years. Behind the 5 years, it means infinite period. That's why they're using terminal value. So by terminal value, so that's why they consider directly same value for terminal value also. Why? Because there is a no growth. Now let's cost 70% of the sales. So you will get FCFE. Now terminal value point of view, this divided by R, then only you will get a value. Now present value factor, so multiply with the FCFE, you will get a present value of cash flows. Sum of all is known as a value of a copyright, not equity, right? Copyright. Next, when I come to illustration number 2, so this also new models we have. Intangible assets valuation. So simple. So as we asked, value of Agarwal Corporation India using excess earnings method. The word itself saying that excess earnings. The difference between some x and y, you will get excess earning. That x and y, I will explain what is x, what is y. The method with following information. Working capital 25 lakhs, fair value of fixed asset 85 lakh, book value of fixed asset 60 lakh, normalized earnings of the firm 13 lakhs. Required return on working capital 6%, required return on fixed asset 9%, required return on intangible assets 20%, weighted average cost of capital 8%, long-term growth rate of residual income is 10%. Now see, what is the value of Agarwal intangible assets? When it comes to intangible assets calculation, you have to figure out residual income. How we get a residual income? That is called excess earnings. That is called excess earnings. Now normalized earnings minus return on working capital minus return on fixed assets, you will get a residual income. So they specified here normalized earnings 13 lakhs, return on working capital 25 lakhs into 6%, 1.5 lakhs, return on fixed asset 20, return on fixed asset 9%, 7,65,000. So 13 lakh minus this both, you will get 3,85,000 is a residual income. Now projected residual income equal to current excess earnings into 1 plus growth rate. 1 plus growth rate. Why? Because they provided a growth rate of 10%. Long-term growth rate of residual income 10%. You have to grow up. So 3,85,000 into 1.1. So 4,23,500. So value of intangible assets. So cash, what are the earnings we have? Earnings divided by R minus G. Why? Because growth is there now. So R is 20%. Growth is 10%. Now 4,23,500 divided by 20 minus 10, 0.1. So 42,35,000 is the value of intangible assets. Case 1 is completed. Now when it comes to case 2, what is the market value of invested capital? If you invested capital, you have to consider working capital, fixed asset and intangible assets. So that is the purpose we calculated. Working capital, fixed asset, intangible asset. Working capital 25 lakh, fixed asset 85 lakh, and intangible assets 42 lakh 35,000. The total market value invested capital is 1 crore 52 lakh 35,000. Hope you guys clear. So residual income equals to normalized earnings minus if any earnings are included in this normalized earnings called return on working capital and return on fixed asset. So next illustration number 3, it also be easy model, market value calculation, profit is given, capitalization rate is given, there is a no growth. So profit divided by R. If there is a growth rate, R minus G. We calculated above, there is a growth rate, there is a no growth rate, just take R. So 2,25,000 divided by 0.075, 30 lakhs. Next, illustration number 4. Next, when it comes to illustration number 4, guys. A corporate issues 1,000 per value of a bond semi-annually, bearing a coupon rate of 10%, matures 15 years, with an expected rate of return of 12%. Find the value of the bond. So when it comes to value of bond equals to present value of a coupon plus present value of face value. So sum of present value of a coupon and present value of face value is known as the value of a bond. Now the point is present value of coupon calculation. So generally so present value of a coupon calculation point of view, when it comes to present value of a coupon point of view, so they every year you receiving as per question, you can observe. So 1,000 is a value of face value, 10% is a coupon. It means every year you will receive 100 rupees. Every year you will receive 100 rupees, right? For how many years? 15 years. So every year 100 rupees into present value factor, 100 into present value factor for 15 years, you will get that value. But here is the issue, they are not per annum, they are semi-annual. Semi-annual means per year you will receive 2 times of interest. It means 50 plus 50 you will receive. How many times? Years is 15. How many times means 15 into 2. 15 into 2. That's why we have a 30 years. We can't write 1 to 30 years and values and present value factor. We have a shortcut formula. We had a shortcut formula for calculation of present value of a coupon. C into 1 minus 1 divided by 1 plus r power n divided by r. So this is a formula for calculation shortcut when it comes to coupon. So 10% per annum, but 10% semi-annually means 50 rupees into 1 minus 1 divided by per annum 12% per 2, because of 2 times it is a 6%. 1 plus 6 power per year 2 times 15 years 30 times 30 divided by r. Now 50 into, take your calculator, 1 divided by 1.06 equal to 30 times. 30 times minus 1 into 50 divided by r. So you will get an answer of rupees 688.22. Next, when it comes to present value of face value, so that equivalent to 1000 divided by, we receiving at the end of the life, right? So the end of the life is nothing but into 1000 into present value factor 6%, 30 years. So 1 divided by 1.06 equal to 30 times. You will get 1000 into 0.174. So the answer is 174. Now the value of bond equals to 688.22 plus 174. Now 688.2 plus 174, 866, 862.2. So this is the formula for shortcut calculation, guys. So if you have a time, you can write years 1 2 3 4 5 6 up to 30 years. Present value factor 6%. For every year you have to write down the present value factor, multiply with 100, sum of all, you will get this one only. But for instead of that, we are using shortcut formula for coupon calculation. So next, so illustration number 5, yield of maturity, they ask yield to maturity, YTM model, and duration they ask, violation of this bond also they ask. When it comes to yield to maturity, this is like a interpolation. So at 15% rate, you have to find out a present value of a benefit. How we get a present value of a benefit means every year interest present value plus that purchased value present value, the realized value present value, benefit present value minus purchase value, you will get a present value of a benefit. So at which present value of benefit have a 0 is the required rate of return, which present value benefit is a 0, that is the yield to maturity. So in IRR is there now. When it come to IRR, so we are calculating 10 at the rate of 10% NPV, at 15% NPV. So this is 2000, this is minus 500. It means present value lies between 10% to 15%. Why? Because if NPV equal to 0, that is called IRR, right? Same concept for yield to maturity also. But in yield to maturity, we are not using NPV, we are using present value of interest, present value of realized value minus present value of investment. So you will get a present value of a benefit. So at particular rate. In the question they provided 15%. If you calculate at 15%, if present value of benefit is 1000, you have to increase the rate to 18% or 20%. If you calculate, you will get a negative answer. So it means yield to maturity lies between 15 to 18%. For that purpose, you have to use interpolation technique. So present value of a benefit at a lower rate divided by present value of a benefit at a lower rate minus higher rate into higher rate minus lower rate. So if you use this, you will get a yield to maturity value. Yield to maturity value. Okay. Next, see, after calculation of yield to maturity is a 16%. So you have to calculate duration. So duration equals to, you have to consider proportion of present value and time into proportion of present value, you will get a duration. Next, volatility. So duration divided by 1 divided by yield to maturity, you will get a volatility. So this also important model, sir. So this kind of questions also you can expect for 7 marks. So yield to maturity is very, very important. So don't follow this formula. Don't follow this formula. So go with the interpolation technique if you are not understand this formula. So when it come to formula, what they used, coupon plus maturity minus price. So the maturity value is 1000, price is 964.07, divided by years of maturity, whole divided by 0 point maturity 0.6. So this formula is not easy to use for calculation. For the purpose, go with the IRR formula for calculation. If you use IRR formula, same you will get a 16% or approximately near to 16%. Both answers will give a same answer, but we can't keep this formula in our mind. Why? Because it's difficult to understand. Guys, clear? So that's it. Workbook problems are completed and important problems also I discussed. Apart from this, you have to figure out value per share problems in my material. Value price per share calculation also very, very important in my material. And warrant calculation is there. Warrant and this value per share, as well as goodwill problem one is there. So these are the three concepts you have to learn in my material without my revision class. Value per price share calculation, goodwill calculation, and warrants calculation. Only one problem is there. So these are the three concepts you have to learn. Okay, guys. So we will close today's session. So this is our last session, guys. Hope you enjoyed my classes. So enjoyed my classes. Trust me, this, if you follow this revision classes and if you solve all problems relating to my textbook, so you can easily crack 60+ marks, guys. Okay, thank you all.